Have you ever wondered if your crypto assets, like tokenized stocks or real estate, are treated the same as traditional investments by the IRS? Well, the U.S. Securities and Exchange Commission, or SEC, has just provided some serious clarity. On January 28, 2026, the SEC established a clear framework for tokenized securities 1, fundamentally changing how these assets are viewed and taxed. This isn't just about new rules, it's about applying existing federal securities laws to the blockchain world. In this video, we're diving deep into what this means for your crypto taxes, how different models work, and the crucial tax implications you need to understand to stay compliant and avoid costly mistakes. Don't get caught off guard. First, let's define our terms. A tokenized security is essentially a financial instrument, like a stock or bond, that's represented as a crypto asset on a blockchain. Think of it as a digital wrapper for a traditional investment. The SEC is very clear. The format, whether it's on-chain or off-chain, doesn't change the fact that it's still a security too. This means all the familiar rules for capital gains, dividends, and losses still apply. Now, a broader term you'll hear is real-world assets, or RWAs. This isn't just about stocks and bonds. It can include fractional ownership in real estate, private credit, art, even commodities like gold. When you buy a tokenized RWA, you're getting a digital claim on that underlying asset, with the blockchain acting as the ownership ledger. This can offer benefits like 24/7 trading and fractional ownership, but it also adds layers of tax complexity. The SEC has outlined different models for how securities can be tokenized, and understanding these is key because they impact your rights and, yes, your tax situation. These models help us understand who creates the token and what it actually represents. The structure of this can have significant downstream consequences for you as an investor. You need to know if you're directly owning a piece of the pie or if there's an intermediary involved. Let's break down these models into two main categories: issuer-sponsored and third-party sponsored. In the issuer-sponsored model, the original company or fund that issued the security is directly involved in them. This is the most straightforward approach. There are two main methods here. The first is the integration method, where the blockchain itself serves as the master file. A token transfer on the network directly updates the official ownership record. It's like the blockchain is the transfer agent. The second is the notification method. Here, the issuer still maintains a traditional, off-chain database for ownership. The on-chain token transfer simply notifies the issuer to update their official records. From a tax perspective, both these methods represent direct ownership of the underlying security. This simplifies things because you're essentially dealing with a digital version of a stock or bond you directly own. Now, things get more complex with third-party sponsored tokenized securities. Here, an unaffiliated third party tokenizes a security issued by someone else. This introduces an intermediary and potential risk, like if that third party goes bankrupt. There are two types: the custodial model and the synthetic model. In the custodial model, the third party buys and holds the underlying security. Then, they issue a tokenized security entitlement, a crypto asset that represents your indirect ownership in the security held by that custodian. You don't directly own the security, you own a claim against the third party. The synthetic model is the most intricate. The third party issues a new and separate security that gives you exposure to the underlying asset, but no actual ownership rights. These are often complex derivatives, like structured notes, with their own specific regulatory requirements. For tax purposes, these models mean you're not just tracking the underlying asset, but also the intermediary's role and the nature of your claim against them. This SEC framework isn't just theory. The market is actively responding and building on it. Companies are working with regulators to ensure compliance. A great example is finance. In a December 4, 2025, letter to the SEC4, this financial technology company outlined its roadmap for tokenized securities. They detailed various pathways, from direct registration to digital native securities, and argued that all these models should coexist to strengthen U.S. markets. This kind of dialogue between industry and regulators highlights the massive momentum behind RWAs. For you as an investor, this means it's more critical than ever to get your tax strategy right from the start, because these assets are here to stay and grow. So what are the tax implications? The fundamental rule is that the tax treatment follows the underlying asset, not its tokenized format. Since the IRS treats crypto as property, and a tokenized security is first and foremost a security, established tax rules apply. When you sell a tokenized security for a profit, you have a capital gain. If you sell for a loss, it's a capital loss. Your cost basis is what you paid for the token, including any fees. Tracking this accurately is absolutely critical. The holding period also matters. If you hold it for 1 year or less, it's a short-term capital gain, taxed at your ordinary income rate. But if you hold for more than a year, it's a long-term capital gain, which gets preferential rates. For the 2025 tax year, these rates are 0%, 15%, or 20%, depending on your income 3. For example, if you bought a tokenized share for $1,000 and sold it 6 months later for $1,500, that $500 profit is a short-term gain. But if you held it for 18 months, that $500 would be a long-term gain, potentially saving you a lot of money. If your tokenized security generates income, like dividends from a stock or interest from a bond, that income is taxable. It's typically treated as ordinary income in the year you receive it. Here's where the crypto aspect adds complexity. You might receive these dividends as stablecoins, like USDC, or even as an airdrop of more tokens. In all cases, you must determine the fair market value of the assets you received on the date of receipt and report that as income. This is a significant tracking burden, because each income event also establishes a new cost basis for those newly received assets. Imagine receiving 10 USDC as a dividend, then using that USDC to buy another tokenized asset. That 10 USDC is income, and its value when you received it becomes its cost basis for any future sale. This is why tools that can automatically track your cost basis across multiple transactions and assets are indispensable. The wash sale rule is a critical tax regulation. It prevents you from claiming a loss on the sale of a security if you buy a substantially identical security within 30 days before or after the sale. This rule has long applied to stocks, and with the SEC clarifying that tokenized securities are indeed securities, this rule will apply directly. While its application to pure cryptocurrencies like Bitcoin has been debated, for tokenized securities, it's a clear-cut case. For example, if you sell a tokenized share of Company X at a loss, and then immediately buy back a tokenized share of Company X, or even the traditional share, within that 30-day window, your loss would be disallowed. This is a key area where investors in tokenized assets need to be very careful to avoid accidentally triggering a wash sale and losing out on potential tax deductions. Navigating these new complexities for tokenized securities can be overwhelming, especially with the intricate tracking of cost basis, holding periods, and income events. That's where dTax comes in. Tools like dTax can automatically connect to your wallets and exchanges, including custom EVM chains if you're using something niche. It processes all your transactions, including ERC-only transfers, DEX swaps, and staking rewards, which are common with tokenized assets. Our 1099-D, a reconciliation center, can help you match broker-reported information against your on-chain records, which is crucial for these hybrid assets. The best method compares all 13 cost basis methods simultaneously, showing you which one saves the most tax dollars in any given year. And our AI tax assistant can answer your specific questions about tokenized security taxes. Check out .com. It's open source and free to start, helping you manage your crypto taxes with confidence. Let's tackle a couple of common questions. First, will I receive a 1099-B or 1099-DA for tokenized securities? If you hold your tokenized securities with a traditional broker or a crypto platform that acts like one, you might receive a 1099-B or 1099-DA, especially as regulations evolve. However, if you're holding them in a self-wallet and interacting directly on-chain, you'll be responsible for tracking and reporting everything yourself on Form 8949. Second, what if my tokenized asset is an NFT? If that NFT represents a fractional ownership in a security, then yes, these rules would apply. But if it's just a collectible or art NFT without an underlying security, it's generally treated differently, usually as a collectible for tax purposes, with its own unique rules. It really comes down to what that tokenized asset represents. The SE sees clear framework for tokenized securities on January 28, 2026, marks a new era for crypto and traditional finance. While this brings exciting opportunities, it also brings significant tax responsibilities. Remember, the tax rules follow the underlying asset, not its digital format. Be diligent about tracking your cost basis, holding periods, and any income received. Understanding the different models is crucial for accurate reporting. Don't let these complexities intimidate you. Stay informed, use reliable tools, and consult with a tax professional if you have specific questions. If you found this video helpful, please give it a like, subscribe for more crypto tax insights, and hit that notification bell so you don't miss our next video. Thanks for watching, and we'll see you in the next one.